Hey gang, it's February 6th. It's a Thursday. The week is almost over. Let's get into the news. A few things we need to talk about. This is big, and I know you didn't expect this, but Donald Trump was impeached. Can you imagine that? What were the odds? We all thought he was going to get convicted. I'm being sarcastic, obviously. Look, the odds were 99.9% that Donald Trump was going to get acquitted, and he was acquitted, and the markets have been assimilating that for the last several weeks. So there's absolutely no news and no surprises that Donald Trump is impeached. And finally, we can move past this, all right? And we can get into the election cycle, which just started recently. That's number one. Number two, Twitter came out with earnings pre-open. The stock is up about 8%. It's looking good for Twitter. It's been congesting for a long time. This is the first time the stock is seeing really positive news. So I'm very happy to see that. And the biggest news of all is it doesn't seem that coronavirus is having a big impact on the market today. That's the first time that I'm looking at global news and I'm not seeing anything about the coronavirus or nothing really major about the coronavirus. So it looks like it's cooling off and it's going to put less pressure on the market. The big news today is, as you know, US and China, they've agreed phase one trade war, it's complete. China's making good on its promise, and they're cutting $75 billion from auto imports, which is substantial. It is substantial. Now, let's talk about the stock market technically. The stock market's making new highs. What I don't like about this is, let me show you this really quick here. What I don't like about this is we're seeing divergence. We're seeing higher highs. Pretend I'm drawing this. See higher highs. And we're seeing lower highs in the momentum levels, which means momentum levels can't reach these levels. That means the market is really, really overbought. Again, we're making lower highs here on the RSI. This is a 10-day RSI oscillator. And we're making higher highs here. So as you can see, momentum levels can't keep up with price. And that's telling us that the market, you guessed it, is overbought again. And we're more than likely going to see a lot of congestion and consolidation. Not going to see a lot of upside. More than likely, we're going to see consolidation, especially in light of this divergence. I'm not getting bearish, but I do believe we're going to kind of move back a little lower and then move higher again. I don't think we're going to move much higher from this level, because there's several things on the table, including 50% of earnings from the S&P 500, coronavirus, trade war, impeachment. There's not a lot of speculative value in the market right now, and the market always has to look ahead. Now, if you look at the NASDAQ, it's just grossly overbought, And if you look, and let me show you something interesting. I show this to anybody who's interested in seeing it, but people don't seem to pay too much attention to this particular indicator, although it's really important. This is the percentage of stocks in the NASDAQ 100 trading above the 200-day moving average. It peaked out. If you look at this line here, this is a 5-year study. And notice every time, let's go to 95% here. There we go, 95 point, let's just go a little higher here. 95.20. Notice every time it reaches this level, look at what happened back here, back in January 2018. Once a certain percentage of stocks gets above the 200-day moving average, there's a limit to how far the market can go. And we reached that level again here. And I don't think we're going to move much higher before moving lower. As you can see here, this is a 5-year chart, and we're at really high momentum levels. Now, let's talk about something that's happening now. Healthcare stocks are reporting. This is the beginning of healthcare. We're fizzling out with technology. Technology did about 70 on average, about 65 to 80% better than expected across the board. Although, keep in mind, earnings have been, they've been desensitized to the current financial economy because they've been lowered. They started out neutral about a month and a half ago, and as we got closer to earnings, the expectations were revised lower, to whereas EPS, earnings per share, was supposed to be neutral, and then it was revised down 2.5% or 3%, and the numbers are coming out better than that. So you always want to take into account the number of negative revisions in light of the positive numbers. Wall Street does that when it's expecting weaker than expected numbers. It starts pricing lower value in, and then the number gets higher, and then everybody rallies, or the market rallies because it thinks it outperformed expectations. But in reality, the expectations were lowered. So this is the S&P 500 healthcare sector. All the S&P stocks, there's between 30 and 60 in there, probably closer to 40 to 60 in there, that are related to the healthcare sector. It's like it's lagging behind the overall market, as you could see here. The overall market's making all-time highs, whereas the healthcare sector is lagging behind. The reason you are seeing the healthcare sector lag behind is because it's actually not really lagging behind. The S&P 500 is just so far ahead because the technology numbers were just so darn good. The technology numbers broke through everything. The numbers were really positive on Apple, on Microsoft, several other key stocks. Amazon just killed it. So what you're seeing in the S&P 500 and really seeing in the NASDAQ 100 is the impact of those tech stocks outperforming earnings. But again, keep in mind, those earnings were revised lower and lower and lower. So just because you're seeing better than expected number doesn't mean numbers were really that great. They were just better than the lowered expectations. You like that? Lowered expectations. But here's the thing, and all jokes aside, next quarter, first quarter of 2020, this is the fourth quarter of 2019 that we're reporting now. The first quarter of 2020 is supposed to be double-digit growth in revenue and earnings per share across the board. That's the first time, and don't quote me, but I believe it's either a year and a half or 2 years that we're seeing numbers that positive. But with that said, the healthcare sector is looking good. I like it, and I think it's going to go higher, but we've got 3 big healthcare stocks that are reporting today. So let's talk about that. First, Cardinal Health, one of the biggest companies. I'm not really thrilled with what I'm seeing. It's been in a downtrend over the past several months, actually, since November. So the stock hasn't been going higher. When the stock market reached new highs, as you could see right here, Cardinal Health did not. It crapped out, and the trend has actually been going lower. Now, it's expected to open up about $3.77 at the 56 level right here, but till it makes new highs and takes out this high and stays around that level, which is 56.70, until it takes this price out and stays above this level for about 3 or 4 days and then pulls back, then it would be a good time to start moving in. I wouldn't be bullish on this stock till I see it sustain price above the 56.60 level, 56.70 level for at least a few sessions. But it is expected to open up about 7%, which is good, positive, and it's telling us that this healthcare sector does have potentially more upside. Next stock on our plate is Bristol Myers. Now this stock looks very similar to the overall. This is the index, and this is Bristol Myers. Talk about correlation, right? Talk about trading the ETF versus trading the stock itself. It looks very similar, and again, it would probably be at all-time highs if it wasn't for the technology sector just prompting the S&P 500 higher. But the stock is doing well. It's, again, slated to open higher at 67.20, which would put it right below all-time highs, very similar to where Cardinal Health is going to open. So both stocks are looking better than expected. This stock I like a lot because it's been in an uptrend and it's been making new highs, whereas Cardinal Health has not. It tried making a new high here. Excuse me, I can't barely speak this morning. I got to have my coffee. But so it made an all-time high here around November, but when it came to January, it did not, whereas the overall healthcare sector did. It took out a high and it's been making higher highs. So if I had a choice between Bristol Myers and Cardinal Health, I would go with BMY, with Bristol Myers, any day of the week because it's been sustaining higher highs before earnings, whereas Cardinal Health has not. The last one is Cigna. And Cigna, again, is looking very similar to Bristol Myers. The stocks look very similar to the overall health sector. I like Cigna. It's expected to open at 212, which would put it, again, very close to all-time highs. But again, this stock made all-time highs as late as January, and the trend has been moving higher. So I like this stock. I like Cigna, and I like BMY, Bristol Myers. Not a huge fan of Cardinal Health, although this can change if the stock comes up here and stays. So if I had a choice between these 3 stocks, I would probably start with Bristol Myers. Second choice would be Cigna because it was congesting here, whereas Bristol Myers was going up higher and higher and higher. So my first choice would be Bristol Myers, second choice would be Cigna, my third choice would be Cardinal Health. But right now with the market overbought, volatility is still high, I would wait for these stocks to cool off before moving in. Now I've got something really big for you. I hope you signed up for Rob Booker's petition yet. What petition? What am I talking about? This is really great because this program was so popular that he sold out, and he's literally created a link for you to click to sign a petition to open it up again. Now get this, check this out. Anyone who signs up before it hits 2,500 will get details of Rob's automatic income strategy. And it's proven to generate thousands of dollars each week with just a few clicks. Now, if you can generate thousands of dollars in income with just a few clicks, you're doing something right. Don't forget, click the link below, sign the petition before it's too late. Again, it's a wildly popular program. It's doing really, really well. Get in on it. It's closed, but you could sign the petition, follow the link below. It needs to hit 2,500 and you'll get details. Again, anyone who signs up before the petition hits 2,500 will get all the details of Rob's new income strategy. It's called Rob's automatic income strategy, and it's proven to generate thousands of dollars with just a few clicks. Don't miss out. Follow the link now. I'll talk to you guys later. Take care.